Hi, I'm Tom Cock here today with Mark Hebner to shed some light on the current climate and whether or not we are in a very different phase than before, and just what generally unpack why investors should be well served by maintaining their cool during hot or uncertain times, anytime when it comes to your money in the market, right?
There's a benefit for staying cool?
That's right.
All right, very good. That's our main message.
It always is.
It is. Stay the
Keep
course.
your cool.
We like that.
Keep
John
your
Bogle likes to say, stay the course,
Yep.
right? This wonderful book here, this Dutch book called The Great Mirror of Folly.
Yeah.
And some people call it the Great Scene of Folly. It depends on your interpretation of the Dutch. But here you can see these investors jumping off the cliff.
Yep.
And we're already seeing a lot of investors sort of jumping off this cliff and selling their portfolio, going to lower risk or going to cash, no risk at all, thinking that they're going to, number one, avoid a drop in the market.
Yep.
But then when the time's right, they're going to get back in just in case, just in time for it to go back up again.
I hope they ring a bell or something.
How does that work?
I don't
Yeah,
know.
ding,
Not
ding, ding. We've got a bell around here somewhere.
Yeah, exactly.
Anyway, that won't happen. The thing that I like investors or you listening to our program out there to most understand is this idea that market uncertainty is already priced into the market. It's Eugene Fama's famous hypothesis called the efficient market hypothesis. And that basically says that all the information known by all these traders ends up getting embedded into prices so that prices are actually fair. And investors are actually protected because we have this system. It's not that prices are fixed and they can't move based on this uncertainty. That's where you'd be in trouble, right? Like an exchange rate that doesn't float, right? That creates a lot of problems for countries
and
who have
companies.
fixed and companies
Yep.
if that were the case. But we have a system that says if I have high uncertainty, if someone wants to buy that stock, they get it at a little lower price than they would have paid before that high uncertainty showed up, right?
Yeah.
So how is it we do this? Well, we have 5 million willing buyers and 5 million willing sellers almost every day. That's an approximate number, who look at all this news, all this information, and through this trading process establish a fair price. We like to say that all that news and information they know is baked into that cake. Can we get a little cake out here sometime? I want a little price cake. We'll light the candles. We should celebrate the price once in a while. Can we have a price day? Let's do that. We can celebrate the price on that day. Anyway, so the prices then end up incorporating the known information as well as the forecasts about the future. And so I don't know if something might be 20% probable of happening, 4 months from now, whatever it might be. The best way to sort of price that probability is let a lot of people negotiate and come to a price.
What's fair?
Okay?
Right.
So the other thing that makes a lot of sense, and I think I'd like our viewers to understand this, is that these prices move inversely proportional to this uncertainty. So if uncertainty increases by a unit of 1, the price should drop by a unit of 1. Okay? Now, we don't really quantify uncertainty, but I think you could actually quantify it by these changes in prices. That's basically what's going on.
And a lot of people have heard that term, the market doesn't like uncertainty.
Yeah.
That pushes the price down. Well,
it pushes the price down.
Yeah.
So then, from that point, what is the investor positioned to do? They're positioned to earn a risk-appropriate, positive, that has to be positive because it's risk, expected return for their investment. Okay?
That's right.
So if that's the case, basically what we'll see is a bell-shaped curve, as we're going to see here. Don't zoom to it yet. I'm going to get to this in just a minute. We should see a bell-shaped curve of future price outcomes.
But show us all the things that go into making that.
Yeah. So one question I would ask of you, who is listening out there, if this system isn't the best way to come up with prices, Pray tell me, what is it?
Give it to us.
Give it to us. Until you show me a better system, we think this works just great. What is the line about capitalism? It's a really bad economic system.
Can't find
it's
a better
just,
one.
It's just better than everything else,
There you
right?
go.
So here's what goes into these prices at the moment. We have about 20,000 companies that are traded out there on publicly traded markets around the world. There are approximately 10 million traders per day, and we could just estimate that about half of them are on one side and half are on the other side of a trade, a buy and a sell. There are about 100 different stock exchanges around the world in all these countries, so it's not difficult for you to place a trade. You get on your computer. We could do it right now on an iPhone or a Samsung device, whatever it is. It's quite easy for you to participate in this market and basically contribute your information or knowledge, right? There are probably 500 million shareholders of these 20,000 stocks around the world. And that would include, grandchildren who have little college accounts. It includes 401k participants. It includes you. It includes me and everybody over here behind these cameras and directing us, right? How many shares are traded a day? The best estimate that we've come up with anyway is in excess of 10 billion.
Wow.
Just the New York Stock Exchange averages about 5 billion. NASDAQ has about 2 billion. And so if we look at the other 98 stock exchanges, I'm sure there's multiple billions out there. But boy, if there are 10 billion shares traded, seems to me that's plenty of opportunity to get to a fair price, right? If we looked at all the shares that are outstanding, we estimate about 10 trillion shares out there to be traded who have an overall market value of about $30 trillion.
A lot of money.
So there's tons of opportunity here for markets to efficiently incorporate information that they know and information that they forecast, they being the traders. And I think we got a really great system for doing this.
How does that happen? Maybe you can illustrate that.
Well, basically, if this process results in a fair price, right? A fair price should generate a fair return. Now, if we can actually simulate that by dropping beads through these pins, and the way this device works, Tom, is every time a bead hits a pin, no matter where it is, it has an equal chance to go left or to go right.
Yep.
Now, if you and I agreed upon a fair price, it should be equally likely that a price in the future will result in a return that's greater than or less than a fair return. So if the fair return is the middle of this distribution, it should be equal, that we would have the equal number of returns on both sides. And the further that return ends up being from the fair return, the less likely it should occur. In other words,
see how few of them there are.
Yeah, in other words, it should be very unlikely that the price that you and I agreed upon ends up being really wrong.
An outlier.
Yeah.
And that's what you're saying right here.
However, this uncertainty of future returns is really important. It's the reason we have an expected return. So everybody says, oh my gosh, my investments could drop again. Well, yeah, that's why you have an expected return, because there's risk, right? Okay, so if we're not going to worry about the price, not easy, by the way.
What do we worry about?
Yeah, what should we focus on? Where should we spend our efforts relative to our investments? It's basically on these things. Make sure you really understand your risk capacity. We've got a survey at ifa.com. You can go in there, take the risk capacity survey, quantify your answers, and from that, you can determine an allocation of risk that in total is what we call your risk exposure. You want to focus on being diversified. Concentrated investments have all kinds of things that could go wrong with them. So instead of having a large chunk of your money in a few things, spread it out so we don't worry about it, okay? And the advantage here, this is what they call the free lunch. A lot of investments, 500 stocks, basically have the same expected return as one stock. They just have a lot less uncertainty of achieving that return, okay? Risk return trade-offs, you have to look at all the investments, look at history, put together a portfolio. You want to tax manage that portfolio the best you can, and most importantly, stay the course.